Nobody in the United States financial system saw this coming. Not the bullion banks, not the Chicago Mercantile Exchange, and certainly not the massive treasury desks at places like JP Morgan or BlackRock. But in the dead of night, during what should have been a quiet trading window, something hit the silver market with a force that most traders will only see once in a decade. A single unknown buyer absorbed as much as $9.3 billion worth of silver exposure. This happened so fast, it triggered emergency alerts across every single metals desk, from London to Chicago. The price action did not follow any normal supply and demand pattern. It behaved like someone detonated a liquidity bomb right under the entire United States silver market. Spreads widened instantly, futures flashed erratically, and market makers scrambled to find hedges they simply did not have. When a move this big happens, insiders do not ask if the buyer is real. They ask the only question that matters. Who has a balance sheet big enough and a motive dark enough to pull something like this off? Every major commodity analyst who looked at the data said the same thing. This was not retail investor FOMO. This was not a big exchange-traded fund purchase. This was not an accident, and it definitely was not natural trading flow. The $9.3 billion entry did not just drip into the market. It hit like a massive shockwave. Now, the United States silver market, especially the paper and futures side, is known to be extremely sensitive to large concentrated orders. But this was different. This was strategic accumulation, the kind that bypasses public order books, moving through private blocks, dark pools, and hidden liquidity routes, the kind designed to keep the buyer identity sealed behind layers of custodians and intermediaries. This is the kind of move you only see from sovereign wealth funds, multinational state actors, or ultra-high net worth syndicates who use metals as a geopolitical weapon, and yet not a single major institution has stepped forward to claim responsibility. The game has changed, and this $9 billion move might just be the opening shot of a financial war. To understand why this move is so dangerous, we have to look at the structural rot beneath the surface of the silver market. For decades, the price of silver has been dictated not by the metal in vaults, but by paper contracts traded on Wall Street. This is the architecture of paper silver, a system built on leverage and the assumption that nobody will ever ask for the real bars. But that assumption just collapsed. The total notional value of silver-linked derivative positions currently exceeds $891 billion. To put that in perspective, the actual physical silver available for delivery at the COMEX, known as registered inventory, has plummeted to just 47 million ounces. Just 3 years ago, that number was 328 million ounces. We are looking at a staggering 86% drop in available physical metal. The system is now an inverted pyramid. At the top, you have hundreds of billions of dollars in paper promises. At the bottom, you have a tiny, shrinking pile of actual silver bars. This creates what insiders call a phantom shortage. The market demand for real physical silver is now nearly 10 times the available supply. When the $9.3 billion whale entered the market, they were not just buying numbers on a screen. They were effectively cornering the tiny fraction of physical metal that remains. Within minutes of this entry, liquidity on the main futures exchange thinned by almost 38%. That is one of the largest single-hour liquidity drops since the 2020 crash. The entire structure is built on a lie that there is enough silver for everyone. This whale just exposed that lie. If even a fraction of these paper contract holders demands physical delivery, the system simply cannot meet it. There is nowhere near enough registered stock to cover the leverage. The United States silver market is no longer just strained, it is fundamentally broken, waiting for the final spark to ignite a total systemic meltdown. To grasp the magnitude of what is happening today, we must look back to the most famous silver squeeze in history. In the late 1970s, two brothers from Texas, Nelson Bunker Hunt and William Herbert Hunt, decided that the United States dollar was a dying currency. They began a massive accumulation program that would eventually lead them to control nearly 200 million ounces of silver. By early 1980, they had driven the price of silver from $6 to nearly $50 an ounce. The Hunt brothers were the original whales. They understood then what the current mystery buyer understands now. In a world of unlimited paper money, physical assets are the ultimate leverage. However, the Hunt brothers made one fatal mistake. They used massive amounts of margin debt, and were transparent enough for the regulators to target them. The exchanges changed the rules mid-game, implementing Silver Rule 7, which restricted new long positions and forced liquidations. But here is why the current $9,300,000,000 whale is much more dangerous. Unlike the Hunt brothers, this entity is operating through dark pools and private block trades, making it nearly impossible for regulators to pinpoint a single target for liquidation. Furthermore, in 1980, there was no solar industry, there were no electric vehicles, there was no artificial intelligence infrastructure. Today, the world is not just speculating on silver, it is consuming it. The Hunt brothers tried to corner a market that was mostly used for jewelry and photography. The current whale is cornering a market that is essential for the survival of the modern high-tech economy. If the 1980 event was a tremor, what we are witnessing now is a full-scale tectonic shift. The ghost of the Hunt brothers is haunting Wall Street, but this time, the stakes are measured in trillions, not billions. The most terrifying aspect for the bullion banks is not just the speculative buying, but the absolute non-negotiable industrial demand. Silver is the most conductive metal on Earth, and in the race for technological supremacy, it has become the ultimate bottleneck. Let us look at the cold, hard numbers that the mainstream media is ignoring. Solar panel production is currently consuming 3,500,000 ounces of silver every single day. As the United States and China race to dominate the green energy transition, this number is projected to grow by 20% annually. Then we have the electric vehicle sector. Each EV contains between 25 and 50 grams of silver, nearly double the amount used in internal combustion engines. This sector alone adds another 670,000 ounces of daily demand. But the real black hole is artificial intelligence. The massive server farms required for AI, the high-performance cooling systems, and the advanced semiconductors all require silver-based components. AI infrastructure now consumes 1,400,000 ounces per day. When you add up these three industries, we are looking at a total industrial drain that exceeds 5 million ounces every single day. The supply chain has been waving red flags for months. Global silver production from mines has remained flat for a decade. Scrap recovery is insignificant. We are running a structural deficit that cannot be fixed by printing more money. You cannot manufacture silver in a central bank. When a whale removes $9 billion worth of supply from a market that is already in a deficit, they are not just investing, they are creating an industrial vacuum. Major manufacturers from Tesla to Samsung are quietly fighting behind closed doors to lock in long-term supply because they realize that without silver, their factories will simply stop running. Silver is transitioning from a simple industrial commodity to a strategic geopolitical weapon. While the United States has been focused on digital assets and paper markets, other global powers have been quietly securing the physical foundations of the future. China, the world's largest consumer of silver for industrial use, has been systematically reducing its silver exports to the West. They are no longer interested in selling their silver for paper dollars. Instead, they are keeping the metal to fuel their own solar and semiconductor dominance. In Russia, the government has hinted at strategic export restrictions on precious metals as a response to economic sanctions. Meanwhile, India has seen a historic surge in silver imports, driven by a massive government push for solar energy and a traditional distrust of fiat currencies. These are not isolated market events. They are coordinated movements in a global chess game. When a hidden whale moves $9,300,000,000 into silver right now, they are positioning themselves ahead of a massive geopolitical supply interruption. Nations stockpile oil when they expect war. They stockpile food when they expect famine. And they stockpile silver when they expect a breakdown in financial stability. This whale understands that in a multipolar world, the entity that controls the physical supply of essential metals holds the ultimate leverage over the industrial capacity of its rivals. We are witnessing the birth of a new era where hard assets, not treasury bonds, define national security. The entry of this $9 billion whale has created a nightmare scenario for the massive bullion banks like JP Morgan and HSBC. For years, these institutions have operated as the primary market makers, often holding enormous short positions to balance the market. They operate on the assumption that they can always settle their obligations in cash. But the whale is not asking for cash. They are asking for delivery. This has detonated a liquidity bomb. Within minutes of the massive purchase, the spread between buy and sell prices for silver widened to 87 cents an ounce. This level of volatility forces banks into emergency re-hedging cycles. They are required to put up more collateral and tie up billions of dollars in capital that was never intended for this purpose. If the price of silver continues to climb, these banks face catastrophic margin calls on their short positions. The ripple effects could easily spill over into the broader economy. To cover their losses in the silver market, major financial institutions might be forced to liquidate other assets, such as United States Treasuries, blue-chip stocks, or corporate bonds. This is exactly how a localized market shock turns into a systemic liquidity crisis, echoing the dark days of 2008. The difference this time is that the Federal Reserve cannot print silver to bail out the system. If the physical vaults are empty, the paper promises become worthless. We are looking at a potential domino effect, where the failure to deliver a few million ounces of silver could trigger a multi-billion-dollar collapse across the global financial bedrock. The big question everyone is asking is, how high can the price of silver actually go? If we analyze the current supply deficit and the massive derivative exposure, the numbers are staggering. Several key factors point toward extreme volatility in the coming days. If the mystery whale continues their accumulation and the COMEX registered inventory drops below the critical 35 million ounce mark, it will send a scarcity signal that the market cannot ignore. Based on current technical models and the history of previous silver squeezes, we could see spot silver jump from its current price of around $79 an ounce to a range between $280 and $350 an ounce. This is not a long-term projection. This could happen in less than 3 weeks if a physical delivery panic sets in. When the industrial users like Tesla or Samsung realize the metal is vanishing, they will stop looking at the price and start buying at any cost just to keep their assembly lines moving. We must also watch the quarter-end reporting window. This is when exchange-traded funds and industrial buyers must reconcile their physical holdings. If the gap between paper claims and actual bars is exposed during this window, we could see intraday price spikes of $20 or $30. In the most extreme scenario, where the major bullion banks are forced into a total short squeeze, some analysts believe silver could even breach the $500 mark briefly as the system resets. The timeline for these triggers is short, likely unfolding over the next 10 to 15 business days. For the serious investor watching this chaos unfold, the strategy must shift from speculation to preservation. The first and most critical action point is to prioritize physical allocation. In a systemic delivery crisis, paper silver certificates and exchange-traded funds like SLV or SIVR carry substantial counterparty risk. If they cannot source the metal, they may be forced to settle your position in depreciating cash instead of the actual asset. Look toward fully allocated trusts like PSLV or direct physical ownership, where you hold the legal title to specific numbered bars. Second, you must avoid leveraged positions. In a market moving $5 or $10 a day, even a small margin trade can be wiped out by a temporary price dip before the next leg up. Third, monitor the inventory reports daily. The COMEX registered silver updates and the warehouse movements in London are now more important than any headline from the Federal Reserve. These are the true vital signs of the global economy. In summary, the emergence of this $9.3 billion hidden whale is more than just a market story. It is a systemic shock that has ripped the cover off a fragile global supply chain. History, industrial demand, and massive debt levels all point toward a moment of reckoning. The United States silver market is highly concentrated, dangerously over-leveraged, and exceptionally fragile. A single well-capitalized entity has just triggered a chain reaction that no institution can easily control. The game has changed forever. Those who ignore the structural scarcity or rely on paper promises are facing immense financial risk. But those who understand the value of hard assets in a world of paper illusions are looking at an unprecedented opportunity. The silver shockwave is here. Make sure you are positioned before the final vault door closes. Thanks for watching. If you found this professional analysis valuable, make sure to like, subscribe, and hit that notification bell so you do not miss our next update on this developing crisis.